Welcome back, traders and investors. Get ready to unlock the potential of the stock market with the fascinating world of option trading. I'm your guide on this thrilling journey. In this video, we'll lay a strong foundation by exploring the basics of option trading, demystifying the concepts, and unraveling the essential terminologies. By the end, you'll be well equipped to make informed trading decisions. So, let's jump right in. Segment 1. Understanding the concepts. Picture this: you are planning to attend a highly anticipated concert, but there's a chance your schedule might change. That's where options come into play. In the world of finance, options grant you the right, but not the obligation, to buy or sell an asset, like stocks, at a predetermined price within a specific time frame. To make this concept more tangible, let's consider an example. Imagine you believe company X's stock, currently priced at $50, will surge in the next month. To capitalize on this potential opportunity, you can purchase a call option. A call option grants you the right to buy the stock at a predetermined price, known as the strike price. If the stock price indeed rises, you can exercise the option, buy the shares at the lower strike price, and pocket the profit. Segment 2. Essential terminologies in option trading. As we dive deeper into option trading, let's acquaint ourselves with the crucial terminologies that will guide our journey. 1. Calls and puts. Calls. 1. A call option gives the buyer the right, but not the obligation, to buy an underlying asset, such as stocks, at a predetermined price, strike price, within a specific time frame, expiration date. 2. Call options are typically purchased by traders who anticipate that the price of the underlying asset will rise. 3. When you buy a call option, you pay a premium to the option seller. 3. This premium gives you the right to profit from the potential price increase of the underlying asset. 4. If the price of the underlying asset exceeds the strike price before the expiration date, you can exercise the call option and buy the asset at the lower strike price, allowing you to benefit from the price difference. 5. However, if the price of the underlying asset doesn't reach or exceed the strike price before the expiration date, you may choose not to exercise the option. 5. In this case, the option expires worthless, and you lose the premium paid. Puts. 1. A put option gives the buyer the right, but not the obligation, to sell an underlying asset at a predetermined price, strike price, within a specific time frame, expiration date. 2. Put options are typically purchased by traders who anticipate that the price of the underlying asset will decline. 3. When you buy a put option, you pay a premium to the option seller. 3. This premium grants you the right to profit from the potential price decrease of the underlying asset. 4. If the price of the underlying asset falls below the strike price before the expiration date, you can exercise the put option and sell the asset at the higher strike price, enabling you to profit from the price difference. 5. Conversely, if the price of the underlying asset remains above the strike price or doesn't decrease significantly before the expiration date, you may choose not to exercise the option. 5. In this case, the option expires worthless, and you lose the premium paid. 1. Strike price. The strike price represents the predetermined price at which the underlying asset can be bought or sold. 1. It acts as the reference point for your trading decision. 1. We'll delve into selecting the optimal strike price to maximize your potential gains. The strike price, also known as the exercise price, is a crucial element in option trading. It represents the predetermined price at which the underlying asset can be bought or sold when exercising the option. Key points about the strike price. 1. Definition. The strike price is the price at which the option holder, buyer, has the right to buy, in the case of a call option, or sell, in the case of a put option, the underlying asset. 2. Fixed price. The strike price is predetermined and set when the option contract is created. 2. It remains constant throughout the life of the option. 3. Importance. The strike price is significant because it determines the profitability of the option trade. 3. It acts as a reference point to evaluate whether exercising the option will result in a gain or a loss. 4. Relation to market price. The relationship between the strike price and the market price of the underlying asset determines the intrinsic value of the option. 4. In the case of a call option, if the market price of the asset is higher than the strike price, the option has intrinsic value. 4. Similarly, for a put option, if the market price is lower than the strike price, the option has intrinsic value. 5. In the money, at the money, out of the money. The position of the market price relative to the strike price determines the option's status. 1. In the money. A call option is in the money when the market price is above the strike price. 1. A put option is in the money when the market price is below the strike price. 2. At the money. When the market price is approximately equal to the strike price, the option is considered at the money. 3. Out of the money. A call option is out of the money when the market price is below the strike price. 3. A put option is out of the money when the market price is above the strike price. 1. Selection considerations. When choosing a strike price, traders consider their desired risk-reward profile, market expectations, and investment objectives. 1. Different strike prices offer varying potential profits, probabilities of success, and levels of risk. Understanding the strike price helps traders evaluate the profitability and risk associated with an option trade. It serves as a critical factor in determining whether an option will be exercised and whether it will result in a profit or loss. Remember, strike price selection should align with your trading strategy and market outlook. 1. Expiration date. Options have an expiration date, which is the deadline for exercising the right to buy or sell the asset. 1. We'll discuss the significance of expiration dates and how to align them with your trading strategy. The expiration date, also known as the expiry date, is a crucial component of options trading. It represents the deadline for exercising the right to buy or sell the underlying asset. Key points about the expiration date. 1. Definition. The expiration date is the date on which an option contract expires and becomes invalid. 1. After this date, the option can no longer be exercised, and its value diminishes to 0. 2. Fixed time frame. The expiration date is predetermined and specified in the option contract. 2. It is typically stated as a specific day of the month. 3. Importance. The expiration date is crucial because it defines the time frame within which the option holder can exercise their right to buy or sell the underlying asset. 3. It creates a sense of urgency and adds a time element to options trading. 4. European and American style expiry. In the Indian stock market, most index options follow the European style of expiry, while individual stock options generally follow the American style of expiry. 1. European style expiry. European style options can only be exercised on the expiration date itself. 1. Traders have to wait until expiration to exercise their options if they choose to do so. 2. American style expiry. American style options, on the other hand, can be exercised at any time before the expiration date. 2. This gives traders more flexibility, allowing them to choose the optimal timing for exercising their options. 1. Monthly and weekly expirations. In the Indian stock market, options typically have monthly expirations. 1. These are known as monthly options or regular options. 1. They expire on the last Thursday of each month. 1. However, if the last Thursday is a trading holiday, the expiry is shifted to the previous trading day. In addition to monthly options, some stock options also have weekly expirations. These are known as weekly options and provide more frequent trading opportunities. Weekly options expire on every Thursday of the week, except the monthly options expiry week. 1. Rollover or closeout. As the expiration date approaches, traders have three options. 1. Exercise the option. If the option is in the money and there is a need to buy or sell the underlying asset, the option can be exercised before expiration. 2. Roll over the option. If there is still time value remaining in the option and the trader wants to maintain the position, they can close out the current option and open a new option position with a later expiration date. 3. Close out the option. If the option is out of the money or no longer aligns with the trader's strategy, they can choose to close out the option by selling it before expiration. Understanding the expiration date is crucial for options traders as it influences the time value and potential profitability of an option. It's important to consider the expiration date when selecting options and to monitor positions as they approach expiration. 1. Premium. The premium is the cost of purchasing an option. 1. It's influenced by factors such as the underlying asset's price, time remaining until expiration, volatility, and more. 1. We'll uncover the factors affecting premium pricing and its relationship to the underlying asset. The premium is a key element in option trading. It represents the price that the option buyer pays to the option seller for the right to buy or sell the underlying asset. Key points about the premium. 1. Definition. The premium is the cost or price of an option. 1. It is determined by market forces, including supply and demand dynamics and factors that influence the value of the underlying asset. 2. Components. The premium consists of two main components, intrinsic value and time value. 1. Intrinsic value. This component represents the immediate value that an option has if it were to be exercised immediately. 1. For call options, it is the difference between the current market price of the underlying asset and the strike price. 1. For put options, it is the difference between the strike price and the current market price of the underlying asset. 2. Time value. The time value is the additional value that an option holds beyond its intrinsic value. 2. It reflects the probability of the option gaining further value before expiration. 2. Time value diminishes as the expiration date approaches. 2. Factors affecting time value include the time remaining until expiration, market volatility, interest rates, and expected future price movements. 1. Bid and ask prices. The premium of an option is quoted in terms of bid and ask prices. 1. The bid price is the price at which buyers are willing to purchase the option, while the ask price is the price at which sellers are willing to sell the option. 1. The difference between the bid and ask prices is known as the bid-ask spread. 2. Significance. The premium plays a significant role in option trading as it affects the cost, risk, and potential profitability of the trade. 1. Cost. The premium represents the initial investment required to purchase an option. 1. It is the maximum potential loss for the option buyer. 2. Risk. The premium paid is at risk if the option does not move in the desired direction or if it expires worthless. 2. Option sellers, on the other hand, face the potential obligation of fulfilling the terms of the option contract if the buyer exercises it. 3. Profit potential. For option buyers, the premium represents the maximum potential loss, while the profit potential is theoretically unlimited. 3. For option sellers, the premium received is the maximum potential profit, but the potential loss is unlimited if the market moves against their position. 4. Time decay. The premium's time value component experiences time decay as the expiration date approaches. 4. This means that options lose value over time, all else being equal. 4. Traders should be aware of the impact of time decay on their positions. 1. Market influences. In the Indian stock market, factors such as supply and demand for options, liquidity, market volatility, interest rates, and the underlying stock's price movement affect the premium pricing. Understanding the premium is crucial for options traders as it directly impacts the cost, risk, and potential profitability of their positions. Traders should carefully consider the premium and its components, along with their trading strategy and market expectations, before entering into option trades. Segment 3. Option Trading Strategies. Now that we have a solid grasp of the fundamental concepts and terminologies, let's explore some popular option trading strategies. 1. Covered call. A covered call strategy involves owning the underlying asset, such as stocks, and simultaneously selling call options against it. This strategy allows you to generate income from the premiums received while potentially limiting your upside potential if the stock price rises above the strike price. 1. Protective put. A protective put strategy involves purchasing a put option for the underlying asset you already own. This strategy acts as insurance against a potential decline in the asset's price. If the asset's value decreases, the put option provides a limited downside protection by allowing you to sell the asset at the higher strike price. 1. Long straddle. A long straddle strategy involves buying both a call option and a put option with the same strike price and expiration date. This strategy is employed when the trader expects significant price volatility in the underlying asset. If the asset's price moves significantly in either direction, the trader can profit from the increased value of one of the options while allowing the other option to expire worthless. 1. Bull call spread. A bull call spread strategy involves buying a lower strike price call option and simultaneously selling a higher strike price call option with the same expiration date. This strategy is used when a trader expects a moderate increase in the underlying asset's price. It allows for potential profit while limiting the maximum loss. Segment 4. Risk management and conclusion. Before we wrap up, it's crucial to address risk management in option trading. Here are a few key points to keep in mind. 1. Educate yourself. Continuously educate yourself about options and the underlying assets you are trading. 1. Understanding market dynamics and staying informed about news and events can help you make more informed decisions. 2. Diversify your portfolio. Don't put all your eggs in one basket. 2. Diversify your option trades across different assets and strategies to spread the risk and avoid substantial losses. 3. Set stop-loss orders. Consider implementing stop-loss orders to automatically sell your options if they reach a certain predetermined price. 3. This can help limit potential losses and protect your capital. 4. Start with small positions. When starting out, it's wise to begin with smaller positions until you become more comfortable and experienced with option trading. By incorporating these risk management practices, you can mitigate potential losses and improve your overall trading performance. Congratulations on completing this introduction to option trading. We've covered the fundamental concepts, essential terminologies, popular trading strategies, and risk management techniques. Remember, practice and experience are key to mastering option trading. So, continue your journey, refine your skills, and adapt your strategies to changing market conditions. Thank you for joining us today, and we wish you the best of luck in your future option trading endeavors. Remember to consult with a financial advisor or professional before making any investment decisions. Happy trading. This is Market Academy, signing off. May your trading adventures be filled with success and prosperity. See you soon.